Welcome to the Safe Wheel live stream, where I share my P&L on 3 accounts and share my proprietary Safe Wheel trading system, options trading system for free. Type in the chat that you can hear me. I want to make sure that my audio is working okay. Also, be sure to post any questions that you might have. I want to get to those questions before I end the broadcast, so the earlier you put them in, the better chance that I won't miss those. Okay, Will says you can hear me. Thank you, Will. Appreciate that. All right. And some guy says he can hear me good. Let's get to the earnings edge. You can see, thank you, less is more. You can see here, my account's actually down again. So I took another loss here with the earnings edge. Let's see. So last week was a small win, and the week before was a rather large loss, and then this one was kind of a medium loss. It was MC McDonald's minus 560. So pretty good loss last week. You can see my account 7,410. So it's down some. It's still up on the year, but not doing as well as I was a month ago or so. That's the way the system is. There's a lot of volatility with it, and that's pretty much what you can expect. You know, you get a few wins in a row, a few losses in a row. So with that, the earnings edge, let me change these numbers here. So my record is 15 wins, 16 losses, and 6 break-evens, and that's since the update over a year ago. And my average win is 961, average loss 641. And you can see here in 2022 how well the system outperformed the S&P. Now, well, let me put in the new numbers here. 7410, 7410. You can see I'm down 10% this year. And then now we look at the S&P. The S&P was up about 10% as of last week, but now SPY is trading at 413.35. 413.35. So now the S&P is up about 8% year to date. So there's a lot more volatility with the earnings edge. So obviously I'm getting outperformed this year. But if you look at the overall total since I started trading this system, still up almost 50%, with the market since 2022 still down 13%. So I just think that's interesting that it's been almost 2 years and the S&P is still down. Okay, so that is the earnings edge. Let's get to the Premier level 5. Take this off the screen here. Take this out. Premier level 5. There's this account here, 35,528. Let's see how that did. 35,528. Oh, down a little bit. 35,528. So you can see here, just underperforming a little bit, but you know, 1/4 the drawdown. So you know, it's still outperforming this year based on risk-adjusted returns. Obviously, I started in April 8th of 2022 with this system, and it's up 12.2, and the S&P was down 6.39 in 2022, and then 2023 you can see 5.5 versus 8. But overall, since I started trading the system live, and I'm showing my P&L right in front of you, up 18.4, and the S&P is only up 1.1% since April 8th of 2022. So you can see that the system not only is outperforming on a return basis, but because it has only 1/4 the drawdowns, it's vastly outperforming. And my record is, I redid all of these. This might be a little bit different than last week because I went back and I went through everything. 23 wins, 7 losses, 10 break-evens, and I currently have 4 open trades. Okay, so on that one, that is the Premier level 5, and you can see in the description here that the cart is closed for the Premier level 5. About 3 months ago, I decided to share that, and I did for a short period. Now I've closed that cart. I'm looking to reopen it early in 2024. All right, so that is the Premier level 5. Let's go to the safe wheel. Right, the safe wheel is where what everyone comes for, right? Because I trade this account right in front of you. Safe wheel 68,816. So let's look at that. See how that's doing. 68,816. So it's up again. 68,816. 68. I think that's numbers off. 6814. 6814. Okay. So 2022, obviously safe wheel outperformed by 40%. And now in 2023, the safe wheel is actually outperforming the S&P 500 by about 3 or 4%. Now, this has about similar drawdowns to the S&P 500. So when you look at the actual numbers, the actual returns, those are very accurate. So on a risk-adjusted basis, it's about a 1-to-1. And you can see since 2022, January, the beginning, I've been trading this live. Every trade that I've made, well, I do trade on Fridays, and I do let people know about that in the alerts. But pretty much every trade I've made has been live in the account. And I'm up 36%, and the market's down 13. So the safe wheel is vastly outperforming the S&P since inception of January 2022. Okay, so now that we're on the safe wheel and you see the results, let's get to the actual trading of the safe wheel. I trade this once a week. Now I do make trades on Fridays where I just spend about $5 on a long call. So I get rid of my long call and I buy a new long call every Friday. So that is part of the trade, but it's not really a significant part because it's like spending $5. But so you can see last Friday, I bought the $36 call that expires this week. So that would have been, a week later. So 7-day. I went out, bought the $36 strike call, which was at that time 7 days until expiration. Now it's 4 days. And I sold the previous call that I bought the previous week before. I didn't get anything for it. It was worth $0. And so I basically bought this, and I paid $7, but I sold the other one for 1 cent, right? So that's what happened last week on Fridays. That's what I do on Fridays. If you're part of the Safe Wheel course, I do have a course. It's for you if you want to make sure that you have it's kind of like a fast track. And if you want to make sure you have every rule set in place, because if you follow me, not every scenario has occurred in real life. But if you want to make sure you get the real life, everything that could happen with a flow chart and the course and everything, you can go, there's a link in the description, you can get the course. Now, also with that, I also do the alerts. So I alert you of all the trades that I make. So on Fridays, you get an alert with that course. Okay, so that's the long call portion. So there's 3 kind of portions that I got to look at here. That's number 1. Number 2, I got to look at my put hedge, right? What is my put hedge doing? My hedge for the system. That's why it's called the safe wheel. It's not the traditional wheel. If it was the traditional wheel, I would just call it the wheel, right? But it's called the safe wheel. And I have this put hedge here where I am at the $30 put. So one of the rules is this put within 70% of the actual price? Well, it's actually in the money, so it's within 100% of the price because the price is $26.60 and this is at 30, so this is in the money. So it's definitely good there. And then also how many days until expiration? It says 109. So once it gets under 100, then I will roll it, or I can start my whole position over. Whenever I remove a put hedge for any reason, there's the opportunity to start over and I can use a different underlying unless I have shares. So it looks like I got 200 shares. So I got assigned last week. What did I sell? I need to take note of that. I believe I sold the 2750 because that's what's in the thing. So I kind of changed the FIFO, first in, last out kind of thing. And now it shows the last price that I got assigned. So I got assigned at $27.50. Now I also got assigned 100 shares at $30.50. So I've got two different 100 share increments that I need to deal with here. So I'm in the third part of this, which is the traditional wheel, and I've got 200 shares. 100 shares was done at $27.50, so I could sell a call at $27.50 or higher for those. Another set was at $30.50. So my first 100 share increment, I was assigned at $30.50. So I need to sell something at $30.50 or higher for that 100 shares. And then I need to sell something at $27.50 or higher for that set of shares. So let's talk about the $30.50 set of shares first. I'm always going to go into the nearest expiration cycle, the one that expires on Friday, today being Monday. That's why I trade on Monday, so I have time, right, between now and Friday, so I can get the most premium I can between now and the end of the week. So if I came in and traded on Wednesdays, it really wouldn't do as well, right? Okay, so $30.50. Something's interesting. Usually there's not this much premium, so what that means is there's probably going to be earnings. And to double check to see that there's earnings coming in this week, you can see the applied volatility. In other words, how much the options are going to move. The expected move of the options is high, 140% versus, next week 101, and then they drop off 88, 70, 78. You can see when this cycle that we're dealing with is like the highest implied volatility compared to the rest, there's some type of event coming out, and typically it's earnings. Really, there's the biggest event for most stock or companies is earnings, unless they're biotech, something like that. There's some type of FDA thing coming up, but I don't trade biotechs. So basically it's earnings, or there could be some other event. Who knows? Maybe in November of next year, there's going to be an election. I don't have any November here, but let's see. So you're going to see like a spike in November. Look at that. So you can see it already starting to kind of spike down here towards the election. So get that out of there. So yeah, you can see it already spiking here compared to the rest. It's probably because of the election coming up in a year. You can see it. So there's another event that'll spike the expiration cycle. But we're dealing with this one here. We're in earnings, and that's a great thing. I like earnings. I'm glad that earnings are coming up. I like that this stock's going to move a lot. I want it to move up or down a lot. Okay, so the first set of 100 shares was at $30.50. Can I sell anything for over $30? And the answer is yes. In fact, I can sell the 31 for $30. So I'm going to sell the 31 because I want to sell something out of the money, as far out of the money as I can. I'm going to sell one of these. And I'm just going to treat these two 100 shares separately. You could treat them combined together and make an average out of them and, come into here and sell. I'm not going to do it that way. That's not the way I've back tested it. So I'm going to go to the 31 here and I'm going to sell. So I've got now the sizing. Okay, so I just sold that. So I filled that order. The sizing is if I have between $5,000 and $10,000, I do one wheel and 3 put hedges. If I have between $10,000 and $15,000, I do 2 wheels and 6 put hedges. So every $5,000, I will increase the increments. Somebody in the course, was it yesterday, mentioned that I don't recall the person's name, but he came up with an idea that I originally didn't like, and that was that if you have more money, maybe you have $100,000, you might take $20,000 increments of that and use different underlyings. So you would use 5 different underlyings, for example. I initially didn't like the idea because I thought I don't want to manage 5 different underlyings. And so I didn't think it was worth it for any type of diversification that you might get. But then as I thought about it more and he brought up more and he talked about it more, I thought, you know what, that's actually not a bad idea because you will create more occurrences. And whenever you create more occurrences, you can smooth out that equity curve And that's really kind of one of the goals, right? You don't want to have a choppy equity curve. You want it smooth. So I like the idea. It's actually kind of a newer idea, or maybe it was brought up in the past. I don't know, but I kind of like that idea. If you got more money, you might want to diversify amongst underlyings. Of course, they need to fit through all the filters. Okay, so we took care of one of our 100 shares. Now our other 100 shares is at 27.50. So let's see what we can do with that. We're going to sell based on the 27.50, so we can definitely get more than 30 cents. We want to get at least, well, whatever our assigned price was, we want to get close to that. So we want to get at least like 28 cents. The other one, we want to get around 30 cents. We're at 27.50 here. So with that, what I like to do is go all the way to where I know I can sell right here. This is like the last one. Like I couldn't do the 31. Well, I want to get, actually, let me talk about this. I want to get about 28 cents. So wherever I can get 28 cents, this I can get 28 cents at the 31 strike, but at 31.50 I cannot. So this is kind of like the last one right here. So what I'm going to do is go one back, and I'm going to sell here. I'm not going to get as much premium, right? But if I get assigned, I'm going to make the difference between 27.50 and 30.50. That's 300 bucks. That's a lot. That's where the money's made with this system. That's what I've found over back testing, forward testing. It's made when you write that covered call far away and get assigned. That's where the chunk of change is really made with the system. So I'm going to sell the 30.50 in relation to my assigned price at 27.50. If you guys have any questions about that, go ahead and put it in the comments so I can be clear about what I'm doing. So I'm going to go ahead and sell this one here. I might try to get $37. It's not filling, so let's go to 36. Okay, so I filled there. All right, so each one of these represents each one of my 100 shares that I have been assigned in the past, and where I don't mind getting assigned. Okay, now I'd have to look up the rules if I remember properly, but if I get to a place where I can't sell any premium against any of my shares, then I would just exit the trade altogether and start over. But I am able to sell. And a lot has to do with coming into earnings. I like earnings. Okay, so that's the safe wheel for this week. I am going to now look at the comments, see if there's any questions. I see a couple here. Martin. Hey, Carl, in the safe wheel, could you please repeat why we are using 3 put hedges to protect the position instead of using 2 puts or even 1 put? Well, this is a good example. I will not sell, I will not open up another tier. I've got 200 shares. I'm maxed out, right? I won't go to 300 shares. I won't go long 300 shares. I won't sell another put here. So to cover 200 shares, I want to be short 300. Because if this DraftKings goes from 26, say it reports earnings, and it goes to $20, I need these 300 puts to outweigh the negative of owning 200 shares. Now, if I went to 200 shares, I would just be breaking even with the shares, but I probably would be at a loss overall in the overall position. If I went with 400 shares, my put hedge would cost much more, too much money. So 3 is where I found is that sweet spot. Will says we're in probably the most safest position we've ever been on the safe wheel. This is also a position we've never been in. Could we sell 2 calls because of the earnings inflation? And the answer is yes, we did sell. I did sell 2 calls because of the earnings inflation. If earnings wasn't coming up, I would have been able to probably sell 1 call, but not 2. And we are pretty safe because we are in the money on our 300 shares. So we're short 300 shares right now. So we're probably better off even in the market if this DK and G goes down instead of it goes up. But DK and G could go down so much that we can't sell any premium, and we would just exit the trade. Kevin says, good morning from Lakeland, Florida. Charles, I had to open a new account, so I'm starting over, giving earnings coming up. At which strike would I be selling the cash secured put? Well, like I like to. So right now the stock's trading at about 26.50. So I want to get at least 27 cents. So what I like to do, you could sell at the 22.50, right? You could sell there, but you would not. You're going to be out of money. Even if you're at 26.50, you're going to be out of the money. All right. So you know you're already out of the money. So I would go to the one that I could sell at 22.50, then one more back, right? So I would do the $23 strike if I was starting over today. Well, this is more. This is the most active wheel event in a long time. Looks like the safe part of the wheel is in full effect with the 3 put hedges in profit in the money. Shouldn't exist the whole thing since, should we exit the whole thing? Yes, there's a time to exit. Typically when the put hedge, you own 200 shares and the put hedge has made more money than the long 200 shares has lost, you can exit based on that. But let's see, how much are the 200 shares? So that's down $182 and the put's up 660. So actually that could be an exit criteria right there. Good question, because I didn't look that up. That could be actually an exit criteria. With all this premium out there though, it's nice to sell these covered calls because I'm still covered pretty well. But yeah, that would be the exit criteria. Own 200 shares and the put hedge is worth more than what we've lost on the 200 shares. That's an exit criteria. Probably, I have to look the rules back up. They're quite detailed and I have to go through the thing, but maybe an exit would be warranted at this point. We're coming into earnings, so I really like the premium that I'm getting, so I took the premium. But that's a really good question. I mean, really the reason why you take this off is because typically you can't sell any covered calls right against your position, so you get out. But it's like when you can sell covered calls against both positions, I mean, you're like, it's a good time to stay in. If this was probably last week where I got assigned here, and I wouldn't be able to sell a premium against my covered calls, I would have exited here. Okay, James. Why is the PL5 one tranche double versus what is possible to send as an order? If you had 15K, you could trade half size. What's the rationale of the double size? The rationale of the double size is that you've got to overcome your commissions and your slippage and your costs and everything like that. And if you're trading with $15,000, you're going to probably break even. So I want to make sure that you're profitable, that people are profitable, that I'm profitable. So I start with a minimum amount that it could be to be profitable, and that's $30,000. You could run 15,000 just to learn the system. Will, instead of exiting, you once decided that if you couldn't sell any premium, you would just hold for 1 week. Don't know if you added that to the rules, but wanted to try that suggestion. So I did try that suggestion of holding when I could not sell any premium, and it worked out. But then I back tested it. I ran more back tests, more recent back tests, and I found that it wasn't worth doing that. I found it was worth to just exit the position, take a loss, and start over. So that is the rule now, where the old rule still applies. Should Charles start now? He may overpay for the put hedge. From Avery. Good question. So let's talk about that. Do you see the put hedge would go in? Probably have to go to the 200, okay? Look at the implied volatility. That's normal implied volatility, you see. So when we're in the earnings, this is called weighted vega. So when we're into the earnings, you can see that the options are expensive as hell, right? Right. You know, and the further you get away from this earnings event, having an effect on the price of what's going to happen. So the earnings event's not going to have very much of an effect what's going to happen in the future, 200 days from now. These options aren't going to be affected by this particular event. So the prices are still way down here at normal pricing, or relatively normal pricing, right? So it's safe to go out and buy something way out here and not overpay, because the implied volatility is significantly lower here. And then you get to collect, you're selling something here, so you're taking advantage of it. But that's a really good question to ask, and something that should be brought out is that it's okay to buy the put hedge right now. And that has to do with weighted vega. Okay, James, the shares still are really at higher average than is represented in the put in the P&L. Okay, the shares though are really at a higher. Okay, so you're talking, you added, this is on top of something. Okay, so are you talking about the PL5 and about using $15,000, and then you said the shares are really at a higher average than is represented in the P&L. I'm not sure what you mean by that. I'm a little confused. Are you talking about the? So when you guys ask a question, you kind of can't continue from what you said before because it gets confusing. You kind of have to restate everything. So if you can do that, James, that would help. Charles, good to know your daughter has got your back. Yeah. Okay. Less is more. I think taking the call premium today is a better move than selling the profitable put hedges. And I agree because of the earnings play. Seems like a tweak to the rules is needed. Yeah, you could be correct. I mean, this is just one of those rare circumstances where typically I would get out of the total position, make my put hedge pay off, but then we're right at earnings, so I can sell both premium for both calls, calls on both 100 share increments. So, I mean, it's such a rare event. I think experience. Do you know how much it would take to add this to the flow chart? I went below the flow chart. It would totally make the flow chart kind of, puts it to a point where it's not readable. It's like too much. And so I think this particular little circumstance right here, if you don't know what to do, just follow the rules and get out and take the money, So I would rather do that than try to expand that flow chart, because expanding that flow chart makes it very confusing. So it's just one of those rare circumstances today. But I could have easily went the other way and that would have been totally fine. Okay, Charles. Okay, James. Sorry, when we were talking about the put hedge profit versus the loss. Okay, so when you're talking about the put hedge versus the loss, you said the shares are really at a high average as represented in the P&L. Still done. So basically I'm comparing how much money I've made or lost by owning the 200 shares versus how much I've made or lost versus compared to owning the put hedge. And when the put hedge outweighs, or you make more money from the put hedge compared to how much you're losing with the 200 shares, then you can exit. Okay, I've got one more question. James, sorry, when we were talking about the put hedge profit versus the loss on the 200 shares. Okay, good. Thanks, James. Yeah. All right. Are there any more questions? I'm going to give it just a couple seconds. I know there's maybe like a 5-second delay. So if you guys have any more questions, I'm kind of going to talk for about 5 seconds here. And then if you're not, I'll be able to close out today's live stream. Okay, I don't see anything else. So one thing I always like to say, if the P&L is not real, wait a second, one last thing. Less is more says, everyone, please hit the like button. Yes, I would appreciate that a lot. That will help me, that will help others find this, and it just helps everyone. Please do hit that like button. Just reach over and hit that right now. Okay, so if the P&L is not real, what else are they trying to conceal? I'll be back next week.